Welcome back. At a time when some experts are saying it's time to think again about dividend-paying stocks, my next guest has identified 7 stocks, and they're not the usual suspects. For more, I'm joined by James Dunn from Dunn Media and also the Switzer Super Report. He wrote this up in the Super Report, and I requested it at the editorial meeting. That's why he did it. How are you, James?
Good evening, Peter. Very well, thank you. Bit chilly down here in Melbourne.
Yeah, well, it can do that down there, you know that. Anyway, mate.
Sometimes.
You're going to warm our cockles of our heart with these stocks you've picked out, because we often talk about the same old stocks, but you've come up with some great ones. So let's kick it off and with your first one.
Well, look, the thing is with dividends, Peter, that obviously the banks and Telstra and Wesfarmers have really become known as the defensive yield plays in the share market, and we've seen people, income-oriented investors, flooding into those stocks, but they are not the only ones around on the stock market. And what I did was just look at the stocks, the industrial stocks, paying fully franked dividends, which you need for your self-managed super funds, which we'll come to a bit later, Peter, because the refunds of franking credits are the real turbochargers of effective yield, which is the yield you get in your pocket. But there's some very interesting stocks, and look, there's some industrial stocks on double-digit nominal yields, just dividend and share price. So you divide the share price by the dividend and then times by 100, and that gives you your yield. So that you've always got to look on the share market at the price, because the dividend is one thing, whether you're using the historical dividend or the prospective forecast. That's one factor in the equation, but the other one, of course, is the share price, which changes, so can change. But look, some of the ones I looked at, GUD, which is a very diversified industrial operation, Davy Pumps, Ryco, Sunbeam, Westfield, etc. Dexion, which is the warehousing. They build these amazing warehouses for companies. That technology is pretty impressive. And that company, Peter, that's probably the best of the yields we're going to look at tonight. That's on present expectations going to pay about 8.3 cents, about a yield of about 8.3%. So you've got a 50-cent dividend and a $6 share price. So you're looking at about 8%. Now what you do then is, if you're talking about a self-managed super fund in accumulation mode, so the tax rate of that fund is 15%, roughly about 1.2 times the fully franked yield. So that gives you 6.7% from that stock. And then if you're in the self-managed super fund and it's fully over into pension mode, where of course the tax rate is nil, that's when you really start to turbocharge your returns. And so that the yield there of 8.3%, 1.2 times that for a self-managed super fund in accumulation mode, Pete, you're looking at 10.1% effective yield. And if you're in the pension mode, you're looking at about 11.8% effective yield to you. So that's pretty impressive stuff. As we're stressing, Peter, it can't be locked in as a guaranteed yield like a term deposit yield is. But even if the yield's cut a bit, if the dividend doesn't flow through as expected, you're still getting a fairly good yield from that.
Yeah, and what's your feeling about GUD? You got a lot of good brands there. Of course, you know, they need retail to be even better. But and the chart shows that it's gone through a bit of a rough time. But I guess if and when retail recovers, it's going to experience an improvement in its performance.
Well, that's right, and most of these stocks are leveraged to the economic environment, which, let's face it, most stocks are. You've got companies that, some of them, all companies have different influences, as we often talk about, Peter. Some of them are exposed to the dollar, some of them more exposed to Australian earnings, but you've just got a really amazing array of industries on the stock market, and that's what people should look at. They can get cash flows from differing industries. So if we look at the next one, Monadelphous, which has been a star stock for a long time, very, very strong in the mineral services or the resources services business. It does a lot of the engineering and mining for companies. Those stocks got hit a month or two ago as China's growth worries seemed to grip the stock market, but China and the resources prices, the commodities prices themselves, have come back a bit, and Monadelphous is very well poised. If you look at Monadelphous, 6.1% dividend expected next year on current prices, so that turns into 7.3% in a self-managed super fund in accumulation, and 8.6% in pension mode. So another pretty strong yield, you'd have to say, from a company, Peter, that has been a star performer, and investors are really wise to treat that kind of company as, again, we can't say you can expect that yield to be guaranteed, but you can have a fairly high degree of confidence in the cash flows and the earnings and the dividend flow from Monadelphous.
And it's got a great track record, James. Let's go to the next one.
Well, DWS Limited, which is an IT company, that's paying at about 7.3%. So for a self-managed fund in pension mode, 10.4%. Fellow IT services company Oakton, similarly exposed to the recovery in business spending, Peter, 6.3%, which swells up to about 9% if you're holding that in a self-managed fund in pension mode. Prime Media, which operates the Prime television network, again leveraged to the comeback in advertising spending. You're looking at about 8.6% there for a self-managed super fund in accumulation mode, and 10.1% for a fund in pension mode, so pretty strong. Another one, Wellcom Limited, which is marketing, technology, solutions and services. It's been a fairly good performer, 7.3% expected this financial year, which comes to almost 10.5% if held in a fund paying a pension. And our last one, Peter, is Mortgage Choice, mortgage broking. So in light of your previous segment, that might... broking of mortgages, that might get a bit of a kick along as people start to realise that there's life left in the residential property market. Mortgage Choice is on 5.5% prospective, this expected payment for the coming financial year, which goes to 6.7% if you're in accumulation mode in your self-managed super fund, and 7.8% if you're getting a pension out of your fund. So if you play around on the market, Peter, play is the wrong word, but look around on the market, do your homework. All of these are fairly strong balance sheets as well. They're not companies in distress, because let's face it, that's a trap for young players, that a high dividend yield on the stock market can actually imply that a company's in a bit of distress.
Yeah, and the interesting thing I liked about this, I know when we tossed it around in the editorial meeting, was that these companies have potential for capital gain as well, but they're also paying dividends, and so they're a nice, I don't want to say punt, they're a nice investment.
Well, Peter, that's what a lot of people don't realise about the stock market, is that in the very long term, you get more. You should always think of it in terms of total return, your dividend income plus your capital gain, and more of the long-term total return comes from the dividend flow. This is if you're looking at the index over a long period of time, the accumulation index. More of the return comes from the dividend flow than comes from capital gain. Now, as you say, it would be lovely to get 5% capital gain on a stock and 5% dividend income every year and get a total return of 10%. That would be lovely. But the thing is, as we all know now, the market is volatile, and there is also the risk of 5% dividend flow and 5% fall in the stock price, taking you to neutral for the year. But the trick is, I suppose, to have more companies in your portfolio that are showing good dividend flow and good capital gain. Have more of them than the stocks that are where the stock price volatility is wiping out the dividend.
Yeah, exactly right, mate. And if people want to read this, you just go to switzersuperreport.com.au, and James's great article is there, mate. Thanks for joining us on the program.
Thank you, Peter.
After the break, we'll find out why regulators have their sights on poor old self-managed super funds.